This is the Hacking Real Estate Podcast, Episode 8.
You know, that kind of goes back to just knowing what you want, like what you want out of life, what you want out of that, where you're going. Are you just buying a rental? Or are you trying to create multiple streams of income that create tax-free wealth, that create generational wealth that will be protected over years? So how do you do that? You don't just buy it. There's got to be a lot of stuff that goes into it. So I think having that end goal in mind is very important.
Welcome to the Hacking Real Estate Podcast, where we dive into the stories of seasoned, hands-on, and tech-savvy real estate investors. We'll learn the strategies and tools they use to maximize returns and minimize hassle, all while navigating the rapidly changing real estate market. I'm your co-host, Brandon Hall, and managing partner of Hall CPA, and I'm sitting alongside my co-host, Vikas Gupta, CEO of Azebo. With our combined 15 years of experience in real estate investing and entrepreneurship, we're here to help you up your real estate game. Let's get hacking.
Hi, everyone. Welcome to the Hacking Real Estate Podcast. I'm your host, Vikas Gupta, and today we have Chris and Ashton joining us. Chris and Ashton are military veterans turned real estate investors and the founders and managers of Valkere Investment Group. Together, they run a portfolio of over $90 million worth of real estate assets, and they each drive each other to empower others to gain financial freedom through their real estate. Chris, Ashton, welcome to the show.
Thank you so much, Vikas. Appreciate it.
Thanks. Good to be here.
So in your own words, would love to hear your real estate journey.
Sure. Back in 2018, I was finishing up 21 years in the military. I joined right out of high school, so that's all I knew. 14 combat deployments, but I was looking for something to do after the military. And Chris actually came to me because he was looking into this real estate thing, and we put our heads together. And essentially, we tried to figure out how we could replace our W-2 income without having to get another job, right? And create more passive income, more streams of income, create more freedom and time freedom, all that. And so that's how it started. Chris has a little bit different version of why, and I'll let him tell it, but that is how it started.
Yeah, IT engineer for about 12 years. And while I was working in a corporate job, I just saw the 401ks weren't doing what they were supposed to. The market was tanking stocks in 2018, and decided to look into what a lot of wealthy people are into, which is real estate. Conversations with my brother, we ended up doing, these deals together, kind of scaling every time. Every deal we've done, we partnered with someone. And so naturally we moved into syndication and joint ventures, deeper and deeper into different types of assets we've done. So we can go into that. But that's kind of how it got started, as just a desire to have a plan B, something better at the end of the runway.
Yeah, no, that certainly resonates. And that's something that we hear a lot. I mean, at this point, to the extent you're comfortable sharing, are you now completely in your real estate business and off the W-2 income?
Yes.
We are. Yeah.
Wow. So goal accomplished in 5 years.
In 3 years, actually.
3 years. Yeah. Wow. Even better.
Yeah.
So would love to hear about that first real estate deal. Can you tell us about what that was and how it came together?
Yeah, absolutely. So the first one, so we put our heads together. We're like, yes, let's do this. We started reading and listening to every piece of content we could get our hands on about real estate investing. We figured that small multifamilies is where we would start. So the proof of concept there, we found we were looking at anything 4 units or less. And Chris had a friend that had some capital that was looking to get into real estate as well. And so we were able to partner with him. He brought 70% of the loan to value. We bought a property all cash. The idea was to BRRRR it, so buy, rehab, rent, refinance, and repeat. It was $209,000. It was only 1 unit was livable, and I only say that because people were living in it. I don't think it was actually livable in my opinion. But the place was a mess, and we had heard that those are the best ones to buy in the beginning because they're so easy to add value to. But it was like a 1930s house, 1935 or something like that. Plumbing, electric, everything had to be replaced. Underestimated the rehab costs, had to raise more money, take out HELOCs and liquidate all sorts of different funds. But we pulled it off, and we were able to refinance, I think, in about 6 months later, because we made the mistake of having him on the loan, and then you can't refinance fast enough. So you have to have some seasoning period. So we learned a lot. We made all the mistakes, and probably to my brother's credit, we wrote down all those mistakes, and we learned a lot from that one. But we cracked a bottle of champagne, and at the end of that one, we're like, oh, we're making $300 extra, which is not life changing. But we thought, okay, we need to go get more then. So Yeah, that's what we did. And we just scaled from there. As Chris said, we took what we learned from that one and repeated it multiple times. A duplex, 5 units, 16 or 13, then 16, then 84, 120, 384 and on. So, but that first deal was, what it is, and this is kind of cool about having a partner is because you can challenge each other, and that's what it was. We challenged each other. We say, hey, let's do this in 90 days. You pull your weight, I'm gonna pull mine, and we're gonna hold each other accountable. And that's exactly what happened. And we learned a lot, especially in the partnering realm, in the outsourcing, how to build a team, how to leverage other people's skills and finances when you don't have them. Right. That has really helped us a lot.
Oh, that sounds great. Yeah. And one thing you said, the extra 300, and that's not a lot, but no. I don't mean that in a negative way. I think back to like I've been in the tech startup world for a long time in multiple early stage startups. And that first deal, that first sale, even if it's $50 a month subscription or a $500, software purchase, it's like ring the bell. That's validation, right? Like it's actually that first piece of revenue is the hardest revenue to get. And then you just keep on growing from there. And after a few years, it's like, remember when we were excited about $300? Like and it just grows. Yep. Yeah, no, that's cool. Yeah. So it sounds like you fairly rapidly moved up from sub 4-unit properties into larger and larger deals. Tell us a little bit about that journey, because a lot of folks that we talk to who are sort of individuals or families investing in real estate just continue to build a portfolio of, SFRs or 2-unit or 3-unit. But, how did you go up larger than that? I think you said 184 was one. Yeah. So tell us a little bit about that journey.
Yeah, so what we did is we built a business around it. And I think if you're going to get serious in real estate, as in creating wealth, you need to develop some kind of business. That business can be just in your family, where you're looking for that business to replace your income, or in our case, it could be providing a service, taken to the next level. And usually when you create a business and you're now selling something or providing a service to people, you can have access to bigger deals because now you're joining with bigger partners and able to leverage your talents. They're able to leverage their talents, and you come together as a partnership. You can do it on multiple levels. We just ended up, once we did our first syndication, which was a 16-unit, ran into other syndicators in that process of learning and vetting deals together and talking to people about the stuff we were doing. And then partners naturally who are doing big things gravitate and start doing things together. And so we just had the possibility to jump on an 84 unit with another partner. And that was kind of our entry into the bigger apartment deals. And we provided a service not only to investors on that deal, but also to our other general partners when we came together. And so it just depends your goal. I'd say you do better when you partner together. So even if you're just doing a single 50-50 joint venture, you're probably going to be able to buy more with another person than you could probably do alone. And you'll probably do better together than you would do alone. It's just that getting past that limiting belief that A, I can't depend on anyone, or B, I can do it all. Once you get past those, really, you can do a lot of bigger deals. So that's just what we've learned.
No, and in terms of scaling and doing bigger deals, what scales and what doesn't scale? So if I'm going from 4 units to 80 units or 380 units, getting a deal done is getting a deal done. So I imagine that scales pretty well. That's not doing a 380 unit deal is probably not 100 times more complicated, but maybe it is. Tell me if I'm wrong. But management is management. So like what scales well and what doesn't scale well when you're talking about 100x difference in unit count.
Yeah, that's a good question. I've never heard it asked like that. So, well, the economies of scale are obviously why people get into larger properties, the risk mitigation, because now you take a vacancy on 100 units versus a vacancy on a 4 unit. That's 25% loss, on a vacancy on a 4 unit. So the economies of scale play a huge role in that. The other thing I would say too, to caveat off of what Chris was saying, the thing that scales really well is the tasking, who you're working with, right? Because now it's a bigger deal. So naturally you're like, well, I need more people and I need partners, or I need people that are experts on this. And so you tend to leverage real experts, people that have done this stuff. You tend to partner with other people that specialize in certain things. Like, so you may have a capital raiser, you may have a deal finder, you may have property manager, you may partner with the contractors or whatever. So now you're not trying to work with like mom and pop teams or mom and pop like businesses around town to do a single family home and get the cheapest price. You're actually looking for professionals. And I think that helps you scale very well. And then additionally, it's probably a mindset thing. As you go bigger, you're like, I'm serious. And you start to brand yourself. It's a mindset. Like, you start to think, this is serious. We're getting serious here. We're talking $50 million properties, right? And that was a huge piece. Chris kind of touched on it. But when we started talking to other real estate investors and talking about where we were going and what we were doing, we were creating a brand, whether we liked it or not. And like he said, people gravitated to that, and the right people gravitate to that, because you're not going to, somebody that buys $50 million properties is going to have a different mindset. They're going to want to talk to different people. And so how you present yourself, whether online or whether in person, is very different, right? And so I think that piece plays a huge role in how you scale and how quickly you can scale.
If you own rental units but don't want to pay for expensive software, check out Azebo, the smarter way to manage your rental properties. With Azebo, you can automate rent collection, find quality renters, simplify accounting and tax prep, get a bank account designed for real estate investors, and save on rental property insurance. All of these services are free through Azebo. Join thousands of real estate investors who trust Azebo to manage their rental business in one convenient platform. Sign up today at azebo.com/HRE. That's AZIBO.com/HRE.
I want to say back to you one thing I heard and make sure I heard this correctly, because I think this could be really helpful for our audience. So one thing that I feel like I heard, and correct me if I'm wrong, you do a $50 million deal versus a $500,000 deal. And the $50 million deal, you can then afford to go support a full-time expert on capital raising or a half expert on capital raising. If you're going to put $5 or $10 million into rehab, you're getting a different class of contractor. And all of a sudden you get expertise in each of these things at a level that you can't afford to do or wouldn't get at a $500,000 deal. And that just makes things easier and, more value add. Is that correct?
Absolutely. Obviously you want to keep costs down, but it's easier because there's more economies of scale, right? To work with a professional at that point. Yeah. Got it.
Cool. So moving away from the acquisition and deal structuring for a minute, how are you managing and operating this vast portfolio of yours?
Yeah, no, it really comes into adopting that mentality that you are playing a role, and pick the role, don't deviate too much from it. So in that case, all these different partners have the different roles, and then they build, the more they focus on them, they build more systems in them, and they get more experience in that role. So in our case, we really focused on becoming more of a fund manager and raising equity. And then you'll lose more experience in other areas, but you're never going to do a 100-unit property by yourself. So you make a decision to focus on one of the aspects of the 100-unit and get crystal clear on it, and then build the systems around it. And that's how you build a business. Eventually, maybe you start building verticals in your business that are in the various roles. So big groups start not having vertical property management in their group, and start having acquisitions team in their group, as well as an equity team in their group, and all that kind of stuff. But when you get started, play the one role, build the systems in that role. For us, that's what we did. We started niching down. Now, if you look at our brand, you invest with us. We're a fund manager. We do certain type of deals. That's what we do. It doesn't say, hey, we'll go be your agent and go get you a deal. Like, that's just not what people see when they see our brand. So that's the way you do it, is niche down on something and then start building the systems around it, and you get better and better at that area. And you can pivot and change at any time, but I advise, get good at the one thing, and then, see how far you can take it, and then start to grow out if you can or want to.
So you mentioned a few different vertical areas in which people can grow: property management, capital raising. What, if any, of those have you decided to put under your umbrella?
The capital raising is a piece we've focused on a lot. But
Mm-hmm.
I will add, one of the lessons we learned early on was the cash flow piece, right? And if you're trying to make a business out of it, you need cash flow. And so it took us about 3 years to figure this out. But as new investors, I think a lot of people get caught up in having to do deals because they have to create cash flow. So then it becomes this scramble all the time. Whereas if you can somehow get something that cash flows from day one, that provides you the lifestyle and allows you to take that load off your shoulders to actually focus on scaling and building the systems and building the team, whereas you're not trying to just fumble through it as fast as you can to get that cash flow. That is very important. And we discovered that in 2022 using Airbnbs actually. So to provide us the financial platform from which to take that pause, build the business, build the teams, actually get our capital raising strategy down. While we specialize in raising capital for large projects, we actually tell a lot of new investors, go get a couple Airbnbs that can provide you, that, unless you already have a job and you're fine working your job, your W-2, and then, doing these kind of projects. But if your goal is to get into big deals, they don't create a lot of cash flow in the beginning because it takes longer to stabilize, right? So that's kind of what I'm getting at here is it helps to have a couple that actually cash flow really well, and vacation rentals can do that very easily. So that's another piece to our business right now is we actually teach people how to do a couple Airbnbs just to get started so that they can go pivot and go wherever they want with the business. It's kind of two-part. We do focus a lot on the capital raising, but we have started helping other people by helping them get their first couple Airbnbs.
So for your first 2 years, it sounds like you were heavily chasing that next deal in order to generate somewhat lumpy deal dependent cash flow.
Yep.
And then you took a break and you said, you know what, let's build up a foundation of assets that throws off fairly reliable cash flow. And then we can sort of not be chasing the next deal, but take some time to invest, build a business, do bigger deals, be more thoughtful. Is that correct?
Absolutely. Yeah.
We did grow the verticals to a degree. So we didn't grow a vertical property management multifamily arm. We did, however, grow a vertical short-term rental property management arm. So we manage about 6 short-term rentals, 5 short-term rentals in-house. And we did those with other partners, but we do the management side of it. And then we added an education vertical where we're teaching people who can invest with us to go do it themselves. So it's kind of these 3 verticals. One is more in private equity, one is more in short-term rental property management, the other is in education. So
how are you managing your long-term rentals? You have an outsourced property manager for that?
Yes. Yeah.
Always. Yeah. Even our small multifamily, we have a couple duplexes and 5-unit, and so we have a smaller property management team for those. And then for the big units, the 50 plus units, that's like the most important piece. So typically they're the close partnership with a bigger company that, usually over $1 billion in assets, and they're well known in the space.
Got it. I want to switch gears for a minute. I think one of the key themes of this so far has been around partners, the value of partners, finding the right partner, building the right team. I do, if you don't mind, want to ask about pros and cons of working with family, because that can be really great if it goes well. That can be challenging, and it's probably not always one or the other, but it's ups or downs. So would love to hear what you can share about how you decided to team up together and how that sort of family business has evolved.
Yeah. So that's a good question. And people have asked that before, but it's no different than partnering with anybody else. You just have, when you partner with somebody else that's not family, you just have this exit plan in the back of your mind. You're like, I can drop that guy at any time, right? When you commit to something, and Christopher and I come from a very disciplined background. Our parents were very committed to success. We understood that, I think, going into it, and we would never let each other down. And so we did get everything in writing because we wanted to be clear about it. What happens if this, what happens if that, right? You do want everything in writing. You do want a legal document that shows who owns what and how many shares, and you want everything protected. And yes, absolutely. So whether you partner with family or friends, it's the same, or strangers. I mean, I would never recommend partnering with a stranger, but the point is, nothing changes. You just need to get very clear about what you're strong at and what they're strong at, what you're weak at and what they're weak at, and how you can complement each other. Get that in writing. It's just like when you get married. If you don't manage expectations early on, you are going to have a rocky road. Like if you don't know what your wife expects of you and you expect of her, like you're going to be clashing all the time. And Chris and I kind of ran through that at the beginning, but there was a few pieces of education that came our way. One of them was traction, which helped us really align our roles. The other one was the disc profile, which helped us figure out our personalities to help us align our roles in the business even better. And now those expectations are really managed. And I'll give you a funny joke about it is like Chris knows that when it comes to like CRM, he's like, oh, you're probably not going to input that data because I'm not a detailed guy. And so like it's a funny thing, but he doesn't get frustrated with it I hope not as much anymore because that's not something I focus on as much. And vice versa, like when I get all excited about a new idea, he's already thinking like 10 steps ahead and looking at all the details, and it kills the idea. But I don't get all, pissed off about that either. So it's like this give and take, and you're always working with that, the different personalities. But once you understand each other, it works out very well. And so that's what I would say, manage expectations early on. If you're going to go into a legal, partnership, make sure it's in writing. Make sure those expectations are in writing. Those roles and responsibilities are in writing. And, Chris actually leaned into that early to get us to do that. And we did, and we have it that way. We each have our own LLC that owns 50% of our holding company. And, so we stress that a lot.
Did you set up all of that legal structure ahead of time, or was that more of, 3-6 months? You're like, oh, we should probably professionalize this a bit.
Chris, I think it was like it was in the first deal or
in process with the first deal. We knew we had to get something underway. The first deal was really a joint venture, single LLC, 50-50. Actually, it had to have been because we included the company LLC as a 50% partner. Yeah, it was kind of in tandem. So basically, the best thing I tell people too is like, you don't have to go build the whole thing from the ground up, but definitely have a call with an attorney. It can save you time later on. Just saying, hey, this is my idea. What's kind of a entity framework that would support this? And they're going to go, well, here's a little pyramid, and you got these LLCs over here, and your trust is this way, and all this stuff. Now, you don't have to do all that up front, but at least you have a guide map of where to get started. And you don't even need an LLC, really, if you're just doing like an umbrella policy, insurance policy on a property or something like that. So for us, we knew we wanted to build a business, and so it was important to have that foundation strong from the start. So that doesn't apply to everyone, but if you want the business, build the foundation. Yeah.
That kind of goes back to just knowing what you want, like what you want out of life, what you want out of that, where you're going. Are you just buying a rental? Or are you trying to create multiple streams of income that create tax-free wealth, that create generational wealth that will be protected over years? So how do you do that? You don't just buy it. There's got to be a lot of stuff that goes into it. So I think having that end goal in mind is very important. We knew that we wanted $10,000 we want $10,000 a month from passive income. That was our goal. All right, how do we do that? And we backwards plan from that. And how do we protect ourselves and protect our investors? And so yeah, having that end goal in mind and planning backwards is very crucial, like Chris said.
Yeah, I guess like it's anything, right? Any business, any project, as you said, right? Like work backwards from the end state. And if you don't know where you're going, you're not going to get there.
Yeah.
Yeah. I do have another question for you. And I say this from experience. As someone who has lost their friend's money in a business venture, have you had the unfortunate experience of losing your friends or losing your family's money? And how did you handle that?
Not yet.
Not yet.
Oh, good for you. Let me tell you, those are not fun conversations.
Yeah, I'll be honest, though. We've had a couple scary moments where money's disappeared and you're like, what the heck? Or going into the 16 unit, like there's a lot of skeptical. We got met with like other syndicators were like, that's under $1 million. That's going to fail. Or what? It's in a C plus asset or neighborhood. That thing's going to be a nightmare. Rents aren't going to do all sorts of things where we doubted ourselves and kind of just, we still went on the project and it ended up doing very well. I ended up crushing it. But, there is a lot of, you get exposure in real estate, but I think one of the things I like about it is other than like a venture capital or business startup or an app, whatever you're building, like real estate's pretty proven. So even if you mess a lot of things up, if you can just hold on for a couple years, 3 years, 5 years, and just ride something out, typically you can get a lot of your capital back It's, can you hold on for that duration? But the same can't be said for crypto or stock. Like, you might never see a crypto recover. You might never see a business app ever launch, and you spent millions in investment on it. So real estate has some level of, I guess, protection, somewhat, which we've been blessed not to lose any money so far on.
Well, and should add too, like there's certain rules we follow when we invest in real estate, right? So the first one is we always invest for cash flow. Always. It has to cash flow from day one. We do value add. And so if it doesn't cash flow from day one, that puts us at risk, right? Because if the market crashes right after we close, now we're underwater and we're not making money and we can't sell it and we can't refinance it, right? But if it cash flows and we can't sell it and we can't refinance it, we can still just hold on to it and it's still paying for itself. And then when the market comes out, like the normal recession on average lasts 9 to 13 months, and then there's a recovery period of 12 to 24 months. That's not that long. That's a drop in the bucket of the history of America, right? So you think if you have a cash flowing property, you can wait 3 years? I think so, And so that's the first one. We always buy for cash flow. We always have cash reserves. And part of the cash flow goes into building that cash reserves. That's our emergency fund. And then we always try to get long-term, low interest rate financing, right? Now, we may break one of those rules, but we will never break more than one of those rules at a time because that puts you at massive risk. And so that's kind of what Chris is saying is like you can just hold on to it, especially if it cash flows.
On the cash reserve subject, is there a rule of thumb that you follow, X% of value or X multiple of rents? Like, how do you size your cash reserve?
It depends on the asset. I think a simple thing for people to follow is usually 3-5, so 5%, 5%. So 5% for vacancy, 5% for maintenance, 5% for CapEx. So if you can do that, that typically will protect you a little bit. Nowadays with debt, it's getting really interesting. You've got interest reserves, you've got CapEx reserves, you've got your renovation reserves, you've got reserve. There's a lot that changes too with the debt, like buying these insurance caps, buying these insurance. We're doing a deal right now. They're putting $500,000 aside just to pay interest for the first year, just to ensure the bank loan is good for the first year. So that's crazy. So yeah, but I used to do the 5-5-5 rule. I think it's a good number. If you're really confident and you can go to 3%. We had a 5-unit, I'll drop it. We had a 5-unit that lost 3 AC units the day after closing. Just someone stole them all. So it's good to have reserves. Sometimes we didn't have enough for that, I'll tell you. But we did have insurance day one. So
yeah, that's another one. Always have insurance, even before closing.
Yeah.
All right. So someone just drove up and took off the window units and drove off.
So C-class, exterior, full exterior, bolted to the ground. They just they took the whole thing apart and took everything out of it.
All the copper.
Typically, you want cages in C-plus areas or some kind of bar to prevent people accessing it.
Yeah.
Yeah. No, that's a story. Yeah, I think the last few guests we've had are pretty much, I think, one of the consistent themes we've had from our guests so far has been almost an opposite strategy of buy high quality property in high quality areas, high quality tenants, and sort of optimizing for minimal sort of operational overhang. And it sounds like, obviously, like there's no one right way to do this, and it sounds like you like to go for more of a upgrade, rehab, build value that way. And you're going to run into some of these instances, right?
Yeah, but that's where the upside is, right? If I buy an A-class property, there's not a lot of upside. Mm-hmm. It's if I buy a B and C class property, we can add value. We can force the appreciation by a couple million in just a year. Like on a 100 to 200 unit apartment complex, and you raise rents $50. That's like a $2 million increase, and decrease expenses like 5 to 10%. That's another $2 million increase in value, just by doing the math. Because just in case people aren't tracking, like apartment complexes, large commercial properties their values based off their net operating income, right? So it's not necessarily what the other properties in that area are selling at. It's what the net operating income is. So if we can increase how much money it's producing every month on 100 units, that's not very hard. It's a lot easier to scale. On a 4 unit, we'd have to increase the rents by like $300 per unit, whereas on a 100 unit, it's only $50 or $25. And, so that's where that scalability comes in too. So, yeah.
Like Ashton's saying, you can depend on the market for increasing the value, or you could depend on increasing the value as well. You could do both. And the biggest we've seen is within a year, a $15 million increase in value.
Mhm.
And when you see that play out in front of you, you're kind of like, okay, I like the value add too. I also like, and that was a B class, so it doesn't have to just be C class asset. But when you see like the potential value add can do, as well as timing in the market or whatever, it's crazy. So
Got it. Oh wow, 15. I was able to follow the mental math on getting to 2. The 15's a bit trickier, but just to walk our listeners through it and to make sure that I have it in my head. So if we have a 100-unit building, I increase rents by $50 a unit. That's $5,000 a month. So let's call it $60,000 a year. That should all drop straight to the bottom line since it's a price increase. So 60,000 increase in net operating income. So if it's trading at around 30 times net operating income, then that would be 1.8 million. Is that how you get to your $2 million more or less?
Yeah. Yep.
yeah, same way.
That's it. Yeah.
When we did our C classes in 2 years' time, we did very much same thing, but we went from like a 500K purchase to a 1.1 million sale in 2 years. And of course, selling in the market previously was really good. But we also took our 16 unit from a $950,000 purchase to a $1.8 million in 2.5 years. So same thing though, just add rents, increase value through the income. Yeah.
Decrease expenses. Yeah.
Where have you found the most consistent opportunities in decreasing expenses?
Management.
Yeah, management's a big one. Utilities, you can get package deals or optimize how people are paying for utilities. You can put in things that are decreasing water costs, tracking what people are using for water and then divvying out back to them in a bill what they're spending on something like rubs. And we've gotten away from being the asset manager, so I'm scratching at some.
And that's why I said that. So this kind of goes back to our first few points is like who you partner, who you bring on the team, the property manager, man, those guys bring a lot to the table. They know the market, they know the tenant class, they know what you can do with the asset, and they know where to implement all these cost saving, these expense, cutting tools and techniques. And that has saved us many times just by finding the right property manager. And on the other hand, we had the wrong property manager, and that hurt us for like 12 months. So until we fired him.
Yeah. So it sounds like with the right property manager, I mean, they're almost paying for themselves.
Yes. Yeah.
I think they're the most valuable position,
Yes.
along with asset management, of course. So you're ensuring you're hitting the projections, helping the property manager with your specified turn or whatever you're trying to do. But property management, asset management, they'll make or break the deal. Obviously, acquisition is important to buy right when you're going in, but that asset management team is literally your business plan. They're driving that business plan. So if they're off the mark with timeline, off the mark with what they could rent for, with the money you spend, it could mess the whole deal up. So,
well, super helpful advice. I think we're almost wrapping up here, but before we get to the closing questions, I do want to ask one more. How has your approach to finding deals, doing deals changed over the last 12 to 18 months with the rising interest rates?
Well, I mean, it's a great side of it. So the short-term rental side, we were finding in-house, and we've kind of paused ours. Now we're getting the management side in order with the short-term rentals we acquired last year. We acquired 4 last year. So we're really getting those in order. I'm part of a mastermind where operators come pitch. So because we're fund managers, we have big operators, think like 1.3 billion in assets. Names, if I mention them, they're very familiar names in the syndication space. And they're coming and pitching to fund managers, and we all get to vet them and see that deal. That's been cool for us as private equity fund managers. But I'd say on a high level, from for us in the short-term rental space, where do we want to go stay? Where do we want to go vacation? And then making sure the data matches in something like an AirDNA or a Mashvisor, and then picking the market like that. But man, those vacation destinations right now are just so expensive that with a 7% interest rate of some kind, it really doesn't pencil very well. So we're looking at like more Midwest destinations.
Mm-hmm.
Where do you want to go in the Ozarks or something? So, but yeah.
Great. No, that must be, that's certainly a great position to be in if you're at a point now where people are bringing you deals and you get to take a look at them and vet them and ask questions. Certainly much different, I imagine, than it was 3 years ago for you too.
Yes.
Yeah. And yeah, we've had deals fall through. I think we've had 3 total that we were raising for that, especially last year. Last year was just rough. People were scared and nervous. Rates were rising. And so we've had 2 deals back out, mainly not because of the investor side, mostly because of the debt. The debt kept changing every week. It's really hard to get a timeline when your debt keeps changing every week. So we had sellers retrading and all sorts of stuff going on, thinking they could get more. So that's been the difficult part when we were doing it that way, with just local relationships, or we had a broker who knew this, had this deal. Now, when you have a more system and like you've got people with even more experience than us in a circle, and you get now the right partners coming in and they're vetted operators, and it's just a lot smoother process.
We had the seller not reporting stuff too. Remember that one? San Antonio, 2 shootings, and then the bank found out about it before we did, and it was weird.
The bank said, "See ya."
Yeah.
And shootings on the property?
On the property.
Oh, wow.
Yeah.
I mean, it sounds like we're looking at really crazy deals, but this is actually in San Antonio. It was a nice,
nice area. Yeah, right.
I mean, it was a B minus. It was not like it's still nice. It was anyway.
But it happens. It does happen. So.
Yeah.
I mean, I might have lived there back when I was like, college or something.
Yeah.
So
Yeah. I remember last June when the rates were going really crazy. We had a couple of customers who, like 24 hours before a loan was supposed to close, the lender just pulled it, said, "Nope, we're not writing loans anymore."
Yeah.
Exactly. And it's so hard to like last minute go find something and then keep everybody who's on the deal comfortable.
Yeah.
So yeah, it was a challenge.
Yeah. Well, great. This has been fantastic so far. Would love to go into our 3 closing questions now. I'll let you 2 decide if you both want to answer them. If you want to trade, I'll leave that up to you 2. But question number 1 is, what is your favorite book? And it doesn't have to be real estate related.
Yeah, that's a good one. Okay, so my favorite book currently is A New Earth by Eckhart Tolle. Very deep thoughts and like presence and awareness and enjoying life. Yeah, so.
I'm not sure I have a favorite. I got too many books, but I am reading Breaking the Habit of Being Yourself by Joe Dispenza. You can tell we actually like spiritual mindset stuff too. So great book though about how at a cellular level how you think changes your reality, but also your identity and all that kind of stuff. So pretty cool.
Yeah, no, those sound cool. I'll have to tell my wife about them. She's much more into the spiritual books than I am, but she's trying to drag me over. So the second question, we kind of touched on this at parts of the conversation. We talked about the importance of cash flow, but then you also talked about forced appreciation and how much value you can get there. So if you had to pick one, cash flow or appreciation, what would you pick as the most important?
I would pick cash flow just because you have more protection. If it cash flows, you can wait for the appreciation.
Yeah, I'd say the same, especially early in the journey, especially midway through the journey. Unless you're retiring and or you have a nest egg, like appreciation's a great game, but you really want to build your empire, and you build that with cash flow initially, or even in the mid levels.
Cash flow pays for your cost of living, right?
Mm-hmm.
Yeah, the appreciation is that's generational wealth, sure, but if you can't get there because you can't pay your way till that time. Like, yeah, you need the cash flow.
Yep. Nope. Makes perfect sense. And I guess especially if the pathway is how do I get off that W-2, you can't do that without the cash flow. Final question. Any other last piece of advice that you want to leave our audience with that you didn't get a chance to cover?
Good question. So I think the last piece of advice I would say, if you're looking to get started and you really want to build a business or retire from your W-2 or something, look into short-term rentals. I mean, that's an asset class that cash flows, like we're saying, 4 to 10 times more than a regular rental, right? It has utility, it appreciates in value. You can force the appreciation of that value. It's valued off of how much money it makes, so you can actually treat it a lot like a small multifamily in the fact that you can increase the net operating income and increase the value and get a better refinance or sale, so it's actually a really good way to practice to get into commercial real estate, honestly. But it's also a great way to just retire yourself in a year, depending on how much you make. But and then additionally, for high net worth people, there's the vacation rental tax loophole, which if you own one vacation rental, all of a sudden your passive losses can be used towards your active income as well. So now you can pay less on your active income as well. So there's a lot of benefits to owning a vacation rental. So that's one of the biggest pieces of advice I give to people, both starting out and high net worth people.
The other thing I say is just know what you're doing this for. You don't have to go build a business. You don't have to do what we did necessarily unless you want to build a business. Building a business is a lot of work. You can go own a couple short-term rentals, like you said, and maybe a couple multifamily that you build up a legacy portfolio with over time, and do that very comfortably while having a W-2 job. That's just my feedback. Is like, know what you sign up for, and don't leave the job until you're ready. Really, like you don't have to burn any ships or bridges until you are ready. So.
Well, great. Well, thank you both very much. This has been fantastic. We really appreciate you sharing your insights, your learnings, really telling us some, insights from your business and letting us into your world for a bit.
Absolutely.
Thank you for having me.
Thank you.